We're continuing our conversation about acquiring plan assets. We can acquire plan assets with cash. We can do it through loans. We saw we could do it through issuing stock. This one is about making trades. This is exchanging a piece of property for another piece of property. Another name for this is non-monetary, no money, exchanges. I want to touch on a couple points before we look at an example. And the first question is, what do we value the newly acquired asset at? You know, the book talks about that we should value this at the fair value of the asset given up or received, whichever is more clearly evident. Sometimes it is evident. I'd say the rule of thumb is to value it, if you have a question about this, is to value it at the fair value of the asset given up. This, in essence, is the price you are willing to pay for that, which kind of resembles cost. The other reminder is a gain or loss. We'll encounter this when we are exchanging assets. What's a gain? What's a loss? It is the fair value of our asset versus what we're carrying it on the books for. So if I'm carrying an asset for $100 on my balance sheet, but I sell it to you for $80, I've incurred a loss of $20. The other way, if I have an asset with book value of $100, I sell it to you for $150, I have a gain over and above the book value of $50. Remember, book value is our cost, original cost, minus accumulated depreciation. The third note on here is commercial substance. We'll look at a number of exchanges of property, plant, and equipment. And one factor that we need to consider is whether the exchange has commercial substance. An exchange has commercial substance if the future cash flows or financial position of a firm change. So if you and I trade delivery trucks, I have a red one, you have a blue one, I want a blue one, you want a red one, we exchange these trucks, they're the same model, they're the same year. Is that going to change anything for our future position or cash flows? No, that doesn't have commercial substance. But if I trade you my delivery truck for your inventory, that's going to change things, right? Or if I exchange my brand new truck for your old truck, that is going to change our future positions as well. With that, let's look at an example in the handout. First, we will look at an exchange of property, plant, and equipment with commercial substance, okay? This says that Information Processing, Inc. trades its used machine for a new model at Jared Business Solutions. The exchange has commercial substance. The used machine has a book value of $8,000. The original cost was $12,000. It has accumulated depreciation of $4,000. We have our net book value of $8,000. But the fair value or the market value of this asset is $6,000. Think about that for a second. Book value of $8,000, market value $6,000. And the new model lists for $16,000. Jared gives Information Processing a trade-in allowance for its old machine of $9,000. So this means that Information Processing, which is the party that we're going to account for here, will wind up paying Jared $7,000 cash, right, in addition to that used machine that we're giving Jared. We're giving Jared the old machine, we're giving him cash. In exchange, we're getting a new machine, and this has commercial substance. So let's take care of this. The first thing that I want to mention as we go through these scenarios is that when we encounter losses, as has been the case for a lot of transactions we've looked at, when we have a loss, we recognize it immediately. When we have a gain, that depends on the situation, and we will look at that in more detail as we proceed with these examples. Let's record this journal entry to reflect this transaction. Do this any way that's intuitive for you. I'm going to go over it the way that makes sense to me, but don't let that limit your approach. When I look at this, the first thing I want to think about is what is the value that I should record this new piece of equipment at? And I'm going to consider what I exchanged for this new equipment. What did I exchange? Well, I exchanged cash. Remember, we need to pay them $7,000. In addition, we need to pay them our old machine. Now, the book value is $8,000, right? But what did we really give up? It doesn't matter what's on our books. The value of this thing's $6,000, as it says in the information. So in total, what are we really paying? What amount should we value this new equipment at? $13,000. So the value that I'm going to attach to this newly acquired equipment is $13,000. Let's think about this journal entry now. I'm going to debit equipment, my new equipment that I've acquired from Jared, for $13,000. Now, if I have exchanged this for old equipment, just like it physically left my property, it needs to leave the balance sheet, right? So I'm going to unwind that old asset on the balance sheet. The first thing is, remember, we paid $12,000 for this old equipment. I'm just going to put old equipment so that I keep this straight. Old equipment, I'm taking this off the books. Originally, we paid $12,000. We also have accumulated depreciation recorded on this equipment. We need to take that off the balance sheet. Accumulated depreciation related to this old equipment is $4,000. Didn't we also give Jared cash? So we've got a credit here, cash of $7,000. Right now we've got $17,000 in debits. We've got $19,000 in credits. I know that this is going to be $2,000. But what is it? This is the loss related to the equipment that we gave up. Let's think about that right here. We had a book value of this equipment of, that was $8,000. The fair value, and now that it has left our possession, we record this. So we have a $2,000 loss on this transaction. So when I record and debit this loss, my debits and credits balance, I've taken the old equipment from my books, also some cash, and recorded the new equipment at $13,000. Let's take a look at another situation for a non-monetary exchange. It's with commercial substance, but it's a situation where we have a gain. Now, as you know, losses are recognized regardless of commercial substance, without commercial substance. This follows the principle of conservatism. Gains, typically, we will defer until we actually sell an asset. Because before we do that, it's kind of theoretical. It's an unrealized gain. But when we exchange non-monetary assets that have commercial substance, this is as close to a sale that we can get, and for accounting purposes, we consider it a sale. Therefore, when we exchange assets that have commercial substance, whether it's a loss or a gain, we're going to record it in the accounting records. Let's take a look at an example from the handout. This one says Interstate Transportation Company exchanged a number of used trucks plus cash in exchange for a semi-truck. The used trucks have a combined book value of $42,000. The original cost was $64,000. Accumulated depreciation is $22,000. Interstate Transportation Company's purchasing agent indicates that the used trucks actually have a fair market value of $49,000. Think about this, we're carrying them on our books for $42,000. Maybe they've increased in value, maybe our depreciation base and useful life or whatever was a bit aggressive. Either way, we have a book value that's lower than the market value. Last sentence, it says, in addition to the trucks, Interstate must pay $11,000 for this semi-truck. All right, let's do the journal entries to record this exchange. First, what am I going to record this newly acquired semi-truck? What value should I attach to that for the balance sheet? Well, the fair value of the old trucks that we're giving up is $49,000. So in essence, we're paying them $49,000 through providing these old trucks. But in addition, the deal is structured that we also need to pay $11,000 cash. So what are we paying, and what should we value this newly acquired semi at? $60,000. So with that, let's start working on this journal entry. I'm going to debit the truck, and I'm going to note that this is the newly acquired semi-truck for $60,000. If I got this new truck, I also gave them my old trucks physically. I need to take them off the balance sheet too, because they're no longer an asset that we own. So let's reverse the cost and the accumulated depreciation associated with the old trucks. So the accumulated depreciation on the old trucks had a credit balance of $22,000. We're going to debit that. That'll take that down to zero. The old trucks had a cost associated with them of $64,000. And I know that we're also sending $11,000 cash in addition to those old trucks. Right now we got debits of $82,000. We've got credits of $75,000. I know that we need to have another credit here of $7,000. We can plug that. But just to think about what this $7,000 is, this is the gain that we have benefited from this exchange. If we think about, and this is our old trucks, our book value was $42,000, I think. Yeah. and the fair value is 49. So when we exchange, which is akin to a sale in this case, we benefit by $7,000 over and above our book value. So this is our gain, and that'll go right there. Let's consider the same situation, but assume that it does not have commercial substance. We know when a transaction doesn't have commercial substance, or when it does, we always record the loss. But here's a situation where we have a gain, but not commercial substance. I said earlier that when we have commercial substance, this is as close to a sale that we can get. But without commercial substance, it's not considered a sale, and therefore we want to defer the gain until we actually sell the asset. So let's use the same situation, assuming that it does not have commercial substance. This is the third situation in the handout. So, considering this situation, if I'm going at this journal entry, my natural inclination, do what I know first. I know that I'm giving up cash of $11,000, right? I'm also giving up these old trucks I have. And so I'm going to take those old ones off the balance sheet. The cost associated with them was $64,000. I'm also going to reverse the accumulated depreciation and bring that down to zero by debiting it for $22,000. Looking at this, I can plug this new equipment. This is the semi-truck. This would be $53,000 to make debits and credits equal. If we think about this in a number of ways, we know that we had a $7,000 gain, right? This is just removing that gain effect. Or we can look at it this way: if we're not thinking about the gain, we're really not considering the fair market value of this equipment or old trucks that we gave up. Instead, we would just consider the book value, which was $42,000 for the old trucks, plus the cash we paid, which was $11,000, and we'd value our new semi-truck at $53,000. Now let's take a look at a final example related to exchanges of assets. This one's without commercial substance. It's a gain. So normally we would not record a gain if a transaction, if an exchange does not have commercial substance, because the future cash flows don't change. It's not considered equivalent to a sale. But what happens if there's some cash involved, some cash received or cash paid? Well, we record a partial gain. And we can think about it this way. If we receive some cash, there is some commercial substance, right? It's kind of like a partial sale. And therefore, if we have some commercial substance, theoretically, we will record some of the gain. How do we come up with this portion of the gain? This is based on a ratio. It's the cash received or paid relative to the fair value of the asset plus the cash. If this ratio is more than 25%, cash is more than 25% of the entire consideration received, then we'll record the entire gain. But if it's below 25%, we'll take that percentage and apply it to the gain and record that portion of the gain. So let's look at this example in the handout. Queen Corporation traded in used machinery with a book value of $60,000. That book value was derived from this, a cost of $110 less accumulated depreciation of $50,000, hence a book value of $60. But this used machinery had a fair value of $100,000. That's a gain, right? A gain of $40,000. But remember, under this example, we do not have commercial substance. So we're looking at a gain of $40,000 and some cash. It says it receives in exchange a machine with a fair value of $90,000 plus cash of $10,000. It asks us to prepare the journal entry. Let's think about this gain. The fair value of the equipment that was exchanged was $100,000. Now we're carrying this on the books at $60,000. We paid $110, we had accumulated depreciation of $50. So when we execute this exchange, our gain is equal to $40,000. Do we record all of this gain? Do we record a partial gain? Let's look at this ratio. So we have $10,000 in cash, and the total consideration or amount received is $10,000 plus the fair value of this newly acquired truck or equipment of $90,000. This is 10%. So it's below that 25% threshold. We are going to record an amount equal to 10% of this $40,000 gain. Let's take care of this journal entry. First, we're giving up equipment that we paid and have on the books for $110,000. That's gone. We need to make it gone from the balance sheet. So let's get rid of the accumulated depreciation balance of $50,000. Now, we also receive cash as part of this exchange. So we'll have cash of $10,000. And based on this ratio, we know the gain's $40,000, but we're only going to record 10% of that. A gain of $4,000. So right now we've got $60,000 in debits. We've got $114,000 in credits. We know that this needs to be $54,000. This is the value that we're going to record the new equipment at for $54,000. We can see it, we can do it through a plug, and that's easy enough. If we want to think about it a different way, we can think about this. We're getting a new machine. Its fair value is $90,000. But I think I did an extra F there. the deferred gain, remember we net a $40,000 gain from our old equipment. The deferred gain is 36. So we can think about this. We're recording it at the fair value, but we're deferring $36,000 of the gain. And this means the newly acquired equipment book value is $54,000.